Welcome to the Deep Dive. Today we're going to break down the Q3 fiscal year 2026 earnings call for the quarter that ended back on November 2nd.
And this is a really fascinating one. I mean, you've had a company right at the center of two massive trends: enterprise storage modernization and, of course, the insane demand from AI and hyperscalers.
Which means every single number gets put under a microscope.
Exactly. And this report was, well, it was a classic mixed bag. You had fundamental strength, a top-line beat, but the market's first reaction was pure anxiety, a lot of volatility.
Right. So our job today is to figure out what drove that fear, especially when the company actually raised its guidance.
Let's dig in.
Okay, so let's start with that volatile print. Give us the headline numbers for Q3. What did the good news look like on the surface?
The good news was the top line. Revenue came in at $964.5 million.
And that was a beat.
A solid beat, yeah. That's 16% growth year over year. And the street was looking for something more in the, $955 to $958 million range. So they delivered on revenue.
Okay, so a top-line beat. What about the profitability metric they always point to, the non-GAAP number?
Non-GAAP EPS was $0.58, pretty much exactly in line with what consensus expected. And that's also up about 16% year over year.
So revenue beat, non-GAAP EPS in line. On paper, that sounds like a good quarter.
It sounds like a solid execution-driven quarter.
But that's not what happened. The stock took a huge dive in after-hours trading. So where's the conflict? What was the number that scared everyone?
It all came down to the GAAP number, the quality of the earnings. While non-GAAP was fine, the GAAP diluted EPS was just $0.16.
16 cents. And the expectation was?
The consensus was looking for about $0.24. So that's a huge miss, almost a 33% miss on the GAAP bottom line.
Okay, so that's an immediate red flag for cost pressures. Something is hitting that bottom line much harder than anyone modeled.
And it's investment, aggressive investment. Remember, non-GAAP accounting strips out things like stock-based comp and amortization from big R&D spends.
So what the market saw was a company pouring money into growth and innovation, and it's hitting the real bottom line right now.
That's it. They're in a high spend cycle, and the market panicked about the immediate cost of that growth. Which, brings us to the other big source of anxiety.
The cash conversion.
The cash conversion, absolutely.
Let's talk about the good stuff first, though. The strategic metrics, the recurring revenue. That picture still looks pretty strong, doesn't it?
It looks fantastic, actually. Subscription ARR, so annual recurring revenue, that hit $1.8 billion. That's up 17%.
And what about the backlog, the future contracted revenue?
That's the RPO, or remaining performance obligations. It grew 24% to a massive $2.9 billion. That's the bedrock of the whole subscription model.
So strategically, the shift to a recurring model is working. It's validated.
Completely validated. Subscriptions now make up 45% of their total revenue. The business is shifting exactly as they planned.
Okay, so that's the good news. Management also pointed to a record non-GAAP operating income, right? Something like $196 million.
Yeah, 20.3% margin, a really strong number on a non-GAAP basis.
But this is where that story just falls apart, isn't it? When you look at the actual cash coming in the door.
This is the tension. This is exactly what the market zeroed in on. Operating cash flow for the quarter was $116 million.
Which sounds okay, but what was the comparison?
Well, that's the thing. It was down about 52% year over year.
52%. Wow. Okay. And free cash flow?
Even lower, just $52.6 million. For a company that's valued on its efficient growth, seeing your operating cash flow get cut in half is, it's a huge alarm bell.
A drop that big has to be about working capital. Was it collections, or was it that huge jump in inventory we saw on the balance sheet?
It was all inventory. Almost entirely. Their inventory levels shot up 76% in just one quarter.
76%. Okay, so was that a mistake or was that on purpose?
Management was very clear. This was a deliberate strategic move. They see the hardware component market getting much tighter.
So SSDs, DRAM, that kind of thing.
Exactly. They see prices going up, and they decided to front load their purchases to lock in costs now and avoid supply chain problems down the road.
Okay, so I have to play devil's advocate here. Is that smart strategic foresight? Or is it an admission that their supply chain is so fragile that they have to burn cash just to keep the lights on?
And that is the billion-dollar question, isn't it?
Yeah.
Management's view is we're buying these components to fulfill massive future orders from hyperscalers. They see it as an investment to secure high-margin revenue later.
But the risk is that inventory just sits there. If demand slows down, that cash is just tied up on a shelf.
And that's the bear case. That's the fear that drove the stock down. Is this temporary, or is it a new, less efficient reality?
Speaking of those massive orders, let's talk about the hyperscaler business. That's really the engine behind all the excitement. How did they do there?
They absolutely crushed it. The original forecast for the entire year was to ship between 1 and 2 exabytes of capacity. They blew past the top end of that range by the end of Q3 alone.
Wow. So the AI build-out is real, and it's accelerating faster than even they expected.
It's happening right now. And that huge volume helped them post a really strong product gross margin of 72.9%.
That margin seems incredibly high, especially if component costs are rising. What's the secret there?
It's the mix. It's two things. First, they're selling more of their high-performance, higher-margin arrays. And second, and this is crucial, the hyperscaler revenue right now is almost pure profit.
What do you mean pure profit?
It's mostly high-margin software licensing and royalties. They said it's over 90% gross margin. It's not about selling hardware at a low margin. It's about licensing the software that runs on the hardware.
Okay, but here comes a big warning. This is the thing that I think kept analysts on edge. Management basically said those 90% margins aren't going to last.
They did. This is probably the most important signal for the long-term story. They explicitly said they're exploring new business models with hyperscalers for fiscal 2027.
Which is code for we're going to have to cut our prices to win these massive long-term deals.
I think that's exactly what it is. They're signaling a trade-off. They're willing to sacrifice some of that sky-high margin percentage in exchange for locking in a massive footprint for the next decade.
So it's a classic scale versus margin debate. Do you make more money per unit now, or do you own the entire market in 5 years?
And their choice is clear. They're going for the footprint. They want to be the underlying architecture.
Let's look at the guidance then. Despite all this anxiety, they guided up, which seems contradictory. What are they projecting for Q4?
For Q4, they're guiding revenue to between $1.02 and $1.04 billion. The midpoint there is about 17.1% growth year over year, so continued acceleration.
And they raised the full year outlook as well.
Raised it slightly, yeah. Say between $3.63 and $3.64 billion for the full year.
And what about operating profit? Did they cut that guidance given all the spending?
No, and this is the key. They actually raised the full year non-GAAP operating income guidance significantly to a range of $629 to $639 million.
So what they're telling you is, yes, the margin percentage might be under pressure from our investments, but the sheer scale and growth of the business means we're going to deliver more absolute profit dollars.
That's the message, more absolute dollars. And they kept buying back stock, too. Another $53 million this quarter.
Okay, let's zoom out a bit. The CEO's commentary was really focused on this big picture idea of an enterprise data cloud. What's the core argument there?
The core argument is that AI fundamentally breaks the old way of doing things. Data can't be trapped inside an application anymore. It has to be able to stand alone, be independent, managed by policy. It's a direct shot at the legacy vendors.
And they back that vision up with a pretty huge partnership announcement this quarter.
A massive one. The general availability of Pure Storage Cloud Azure Native. This was developed jointly with Microsoft.
And this isn't just another marketplace listing, is it?
Not at all.
Yeah.
This is their actual block storage service, fully managed, running natively inside Azure. It's a true hybrid cloud play. It lets you manage your on-prem and your cloud storage through a single pane of glass. It's a huge step toward breaking down vendor lock-in.
So all this innovation, the Azure partnership, updating their arrays, it all points back to that R&D spending we talked about. They see it as essential.
Completely. They literally said to expect significant incremental investments to continue well into next year. They believe they have a window right now to win the architectural battle for the next decade of data.
And they're willing to take the hits on GAAP profit and cash flow to win that battle.
That's the trade-off they're making right in front of everyone.
And all of this is happening as the macro environment for hardware is getting trickier. You mentioned SSD and DRAM prices are going up. How does that play into their strategy?
Well, interestingly, management argues it actually helps them.
How so?
Historically, when component prices go up, it hurts their cost plus competitors more. Those guys have to raise their sticker prices immediately. It actually makes their own offerings look more competitive by comparison.
So rising prices make the competition look more expensive, and I would imagine it also makes their subscription model a lot more attractive for customers.
Exactly. That's the other big effect. It pushes customers toward their Evergreen One subscription. Think about it. If you're a CIO, do you want to make a huge capital expense on hardware when prices are volatile?
No, you'd rather have a predictable monthly operating expense that shields you from that volatility.
Right. The subscription model basically acts as a hedge for the customer against all that component price chaos. It's a structural advantage for them in a tight market.
All right. We've laid out the whole picture. We have the fundamental strength, the vision, and this really clear tension between the gap miss, the cash flow problem, and the future margin warnings.
And that tension is what makes the stock so interesting, so controversial right now. It's the sacrifice of today's cash for tomorrow's scale.
Which brings us to our segment. This is not financial advice. We look at all this volatility and pitch a speculative, outrageous, but plausible trade idea for experienced investors only. This is hypothetical, of course.
Of course. But the setup here is just perfect for this kind of play.
Hmm.
You've got a stock that ran up 77% in 6 months. It beats and raises.
Yeah.
And then it gets hammered after hours. The fear is already in the price.
So how do you trade that contradiction? The proven growth versus the stated future risk?
I think you execute what you could call a volatility arbitrage growth confirmation strategy. It's 2 parts.
Okay, what's part one?
Part 1 is you go long the shares, you buy the dip. You make a bet that the after-hours panic was an overreaction and that the fundamentals, the exabity beat, the guidance raise on operating profit dollars will eventually win out and drive the stock back up.
So you're betting on the growth story. But what about the hedge? How do you protect yourself against the very real risk that management just guided to? The risk of margin compression next year.
And that's the critical second part. You simultaneously buy a defensive put option.
Yeah.
Or, if you want to get more complex, you could do a bear call spread. And you time it very specifically.
Then
You target an expiration in mid to late fiscal year 2027. That's the key, because that's exactly when those new hyperscaler deals and the full weight of this investment spending will be hitting the income statement. You're hedging against the precise risk at the precise time management warned you about.
So let me summarize the thesis. You're playing for a near-term bounce based on strong fundamentals, while simultaneously buying insurance against the long-term margin risk that management themselves just put on the table.
That's the play. It's a way to capture the upside of the growth story while respecting the very real risks they've laid out for fiscal 27. A really interesting play on risk and reward.
It is. I mean, this whole quarter was about management signaling a choice. They're choosing scale over immediate profits.
And the question for you, the listener, is whether you believe that choice will pay off in the long run.
So that leaves us with the final thought. If these new AI-native storage architectures really do become the standard by, say, 2026 or 2028, how much time do they have? How long can they go on with suppressed cash flow before that margin anxiety stops being a buy-the-dip opportunity?
And starts becoming a permanent structural red flag about their business model. The clock is definitely ticking on that cash conversion story.
A lot to think about. Thank you for joining us for this deep dive. We'll see you next time.